What is the carry trade?
So going back to interest rates, some countries have higher interest rates than others, and so it's natural to want to invest in those. We mentioned Brazil. So Brazil has high interest rates at the moment, so a natural tendency would be for investors to invest in there because they get maybe 8% compared to like 0.5% here. Back in the 90s, a favorite carry trade was buying dollars and selling yen. So it meant borrowing in yen where the interest rate was close to zero and investing in dollars where you were getting 5%. And so that sounds great. Well, it's great as long as the currency, because there's two components to the carry trade. There's the interest rate differential, but then there's also the move in the currency. So you want the currency to move in your favor as well. So for instance, let's look at dollar yen. If you buy dollar yen, you're earning 5% a year, then you're hoping that dollar will appreciate against the yen as well, so you get a double whammy. And that's really what the carry trade does. The carry trade says or postulates that the higher interest rate currency will actually move in your favor, and you're going to get a double whammy on the market move as well as the interest rate, which is much higher than the currency that you're selling, effectively borrowing against.
And does it work?
It does work. However, the carry trade is an expression, a macro expression, that the world is benign. When the world goes pear-shaped, carry trades get unwound heavily. And a really nice example is 1998 as well as 2007, and I lived through 2007. In 1998, people had to unwind dollar yen because they were incurring losses on a lot of other positions, primarily driven by the Russian default. In October of 1998, dollar yen more or less within a day managed to move from something like 120 down to 104, 103 or even lower. So these are 17 big figures in a day where sometimes the price just gapped. I mean, this is like a 17% move on a currency in one day, which is virtually unheard of. And there was blood in the streets on this. You know, people lost billions of dollars on this. So when you have these massive global shocks, carry trades get affected. And so in 2007, you had a very similar situation. It was already the flare-up into the great financial crisis, the credit crunch that we saw. And what happened in August of 2007 was that, again, the yen crosses, because yen, again, was at that time a favorite funding currency, meaning a currency with low interest rate that allows me to borrow in yen and invest in high-yielding currencies. Those yen crosses were heavily unwound, particularly Aussie yen. Australia was having high interest rates and people invested in Aussie yen and Kiwi yen, and it just all collapsed. And I was actually very fortunate because at the time I was trading a portfolio that had a very strong carry component. And already you were seeing the yen interest rates wanting to nudge up at the start of 2007. And at the time, that portfolio was incurring losses. And senior management asked, well, what are you going to do about it? And I said, well, it's within the statistical framework of the model developed. I'm comfortable. Indeed, from February of 2007 right into July of 2007, that portfolio made a lot of money and very good money. The problem, however, was I still lived with that kind of issue in terms of, you know, how do you really understand the left tail or the losses on this portfolio, because when senior management breathes down the neck, it's not a very pleasant experience. And I said running or trading in a hedge fund is very difficult because you're trading other people's money. And when they ask you what's going on, you need to have an answer. And so focusing very much on the loss behavior of carry trades, what you tend to find with these kinds of trades is that once they start to lose big, it's not just a blip and then reverts, they start to accelerate. It's like waterfall. So there's certain strategies that have this type of waterfall behavior. And if you can actually anticipate or find when it's first gone off a cliff, you can stop yourself out, meaning you just shut down the system because you're anticipating something nasty to happen. And that's what happened on the 25th of July 2007. Already the Nikkei started to collapse. Volatilities in Japan started to go up. VIX was going up. We had a big loss on that portfolio. I mean, big is all relative, big compared to the P&L that we had up to date on a daily swing. So the daily swing was quite big, and we shut the system down. And since, in terms of getting back in, the portfolio had a certain time decay to it, which was at the time around about 4 or 5 weeks, there was not much to do other than to go on holiday. And I remember at the time being in Spain when that news hit the FT all over the place. And at the time, my wife had taken my BlackBerry and thrown it out the window because she couldn't stand me on this stuff. So I was actually blissfully unaware of what was going on in the markets. And thank God the system had stopped that. And when we came back in, we started trading and actually were profitable until the end of the year. But yes, carry trades have that nasty component. And That's a feature of these types of systems. So you have systems that bleed you money, but then knock it out of the ballpark. So that's trend following. Or you have systems that grind out returns slowly, 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 but for the benefit of constantly making money, you got to face falling off a cliff. And when you trade these kinds of systems, you always have to be mindful to detect that big initial shock, because that's a very strong indicator you need to get out. So a classic example of that that's very popular in the retail space is something called martingale trading. It's a type of money management where as you lose, you actually increase the position that you have. And certainly in the market that's oscillatory like this, it's very profitable and churns out returns one after the other. However, it just like a carry trade has that signature of wanting to get off a cliff. And when it gets off a cliff, the best thing to do is to just get out. And that is interesting because I think we're going to come to trading systems later on. Trading systems are not things that are detailed and very idiosyncratic to themselves. They're themes that are going on. So the carry trade is a theme of essentially eating like a bird and dropping it like an elephant.